Most traders set their risk as a flat number of pips or a lot size that feels right, and one ordinary loss destroys the account. I blew up my first account in 3 months, turning $100 into about $20, sure that the fix was better trades. It was not. What later kept my account alive was a 90-second calculation I ran before every entry. So I'm going to show you the calculation that makes every loss the same small slice so that a losing streak bounces off instead of ending you. You keep your risk small and it still stings when one careful trade costs far more than the last. A trader called Larry Hite built a firm that grew from $2 million to $800 million on one unbreakable rule. He never risked more than 1% of the account per trade, because at 1% he was indifferent to whether any one of them won or lost. The size was always small and always the same. Open your trading platform tonight and you'll agonize over the entry while his protection was the size he had already decided. So before you ever look at a chart, you decide the one number that protects you. You take your account, you take a small slice of it, somewhere around 1%, and that slice is the most you'll ever let a single trade cost you. On a $2,000 account, that slice is $20. $20 on the quiet trades, and $20 on the one you would bet the house on, win or lose. Picture 10 losing trades in a row as 10 little red bars. And because each one costs the same $20, they line up at exactly the same height. That's the shape you are building. And I call it the event staircase. Every loss is the same small step down. And ignore anyone selling you guaranteed weekly returns, because that fairy tale is exactly what makes a person throw $100 at a $20 trade. But a fixed $20 is useless on its own, because the moment you open a chart, $20 is not a position. It isn't a number of shares or a lot size. And the size that produces exactly that loss is different on every chart you look at. So how do you turn one fixed loss into the right size for this trade in seconds? Two traders take the exact same trade on the exact same account, and one loses 1% while the other loses 8%. Same chart, same entry, and the gap between a shrug and a sleepless night is one number neither of them was ever taught to run. The reason that gap exists has nothing to do with charts, and one of the clearest versions of it that I know is in a tailor's shop. Walk into a proper tailor and ask for a jacket, and they don't reach for a standard length of cloth and cut everyone the same. They measure your shoulders, your arms, your chest, and they cut a different amount of fabric for every single person who walks through the door. The man after you, built completely differently, gets a completely different cut. The measurement changes for every customer. The one thing that stays identical is the fit. A fixed one size length of cloth would hang off one person and strangle the next. And the only way every jacket fits the same is if the cloth is different every time. You have set the same fixed trade size or the same fixed number of pips on a tiny quiet market and on a violent one, and felt disciplined because the number stayed the same. That sameness was never protecting you. Oversizing on the violent ones is the slow leak that drains most accounts. The exact thing the free diagnostic quiz in the description below is built to find. Get your diagnosis today with the link below. So here's the sum, and it runs backwards from the way most people do it. Most traders pick a trade size first and then go hunting for somewhere to put their stop. You are going to do the opposite. You start with your fixed loss, the $20 we set, and you let the trading chart hand you the size. First, you find where your stop loss has to sit for the trade to be wrong, and you measure the distance from your entry to that stop loss. Say you buy a share at $50 and the stop loss belongs at $48. That's $2 of risk for every share you hold. Then you divide your fixed loss by that distance. $20 divided by $2 a share is 10 shares. You buy 10 shares, and if it hits the stop loss, you lose exactly $20. That $20 is the loss you choose made real to the dollar. Now take a calmer setup where the stop loss only sits $1 away. $20 divided by $1 is 20 shares, double the size of the last trade, and the loss underneath is still exactly $20. Notice you have not predicted a single thing about where the market goes. The trade size changes so that the loss never does. Then you set your target at twice the risk. So the trade that works is aiming to make $40. And the same sum tells you when to walk away. If a market is so wild, the stop loss has to sit at $25 from your entry. $20 divided by 25 is less than 1 share. The smallest position you could even place would already blow past your slice. So you don't take it. And the sum just vetoed a bad trade for you. Guessing your position size is the first lane to a blown account. This is how you stop guessing, and I call it the backwards lot, because you decide the size last after the chart has shown you the stop. That sum is easy to run on a calm Tuesday afternoon. But the first time you will run it, 3 losses deep with red on the screen and your confidence gone, your hand starts wanting to change the number. And that one small change is where most small accounts actually die. The moment a small account dies is usually a quiet, sensible feeling decision made halfway through a perfectly normal losing streak. The big dramatic loss gets the blame, but it rarely does the killing. In the back half of 2021, I went through the worst run I had ever had. 9 losing trades. About 15% of the account gone. And it dragged out over 4.5 months. So it was never one clean punch. It was a slow bleed. A red mark every couple of weeks. Just often enough to make me doubt everything. I remember sitting in front of a fresh trade setup. A good one. One that ticked every box. And the only thing I could think about was the size. Everything in me wanted to cut it in half, telling myself, just go smaller until the run turns, then build back up. It sounds so reasonable. It feels like discipline. But shrinking the size mid-streak would only have shrunk the very trades that were about to pull me out, while the edge that made each setup worth taking had not changed at all. So I kept the slice exactly where it was. I took the next trade at the full size, and the one after that, and somewhere in there, the market turned in my favor. So here is how you hold off the line when it's hard. First, you set the slice once before you are under any pressure, and you set it at a size you can genuinely live with. The honest test is a night's sleep. If holding a trade overnight would have you reaching for your phone at midnight, the slice is too big. So you shrink it once. Now, while you are calm, until a loss at that size would honestly bore you. Then you lock it. I don't shrink my size in the middle of a losing streak. The edge that made the trade worth taking did not change just because the last 3 went red. So the slice does not change either. And that lock slice is the whole reason the losing streak can't bury you. A run of red at the same fixed slice barely scratches the account, since every loss is the same small step. The real danger was never the streak. Skip the calculation just once. Let one normal looking trade run 4 times too big, and that single trade can wipe out what your last 5 winners built. The only time the number moves is up, because as the account grows, you run the same calculation on the bigger balance so that the slice grows with you. Tonight, before anything else, open your platform, take your account balance, and write down your one number, the exact amount a single trade is allowed to cost. That's the first thing you do. Do that, and you stop being the trader who is one bad week from gone, and you become the one still standing, while the people who bet big are filling in another deposit form. But that whole calculation rests on one number that I had you measure but never place. That is the distance to your stop loss. Put it in the wrong place and the cleanest sum is just sizing off a guess. So watch this next, where I show you how to set that stop loss from the market's own volatility. See you in that video.